When I started trading many years back, one of the biggest challenges I encountered was not having enough funds to start selling options on stocks that I really liked. After all, when selling options, you can be assigned the stock if it falls below the sold strike price at expiration. So I started looking at the stocks that were cheaper, paid great premium, but was always worried about getting assigned. After all, these were growth companies, but they were not profitable yet, meaning if you got assigned, you could be bag holding for a while. So, with some curiosity and research, I encountered the world of leveraged ETFs. Hi, my name's Gautam. I'm a former finance executive turned options trader, and I'm here to help you escape the 9 to 5 grind like I did with the power of options trading. So if you're ready to change your life, hit that like button, subscribe to my channel, and let's get started. Also, don't forget to sign up for my free options newsletter, link in the box below. So let's start by understanding what leverage ETFs are. Leverage ETFs are financial products designed to amplify the returns of an underlying stock or index. For example, TQQ aims to deliver 3 times the daily performance of the NASDAQ 100 index. This means that if the NASDAQ 100 index goes up by 1%, TQQ should ideally go up by 3%. However, keep in mind that this amplification applies to losses as well. So why sell options on leverage ETFs? Selling options on leverage ETFs can be a game changer for traders with smaller accounts for a few reasons. First, the amplified price movements of these ETFs can lead to higher premiums compared to the standard ETFs or stock. Secondly, you have a way to indirectly trade the actual stock or ETF for a fraction of the capital required. Now, let's discuss some of the risks of trading these leverage ETFs. The leverage ETFs can be really volatile, and while this can lead to higher premiums, it can also lead to substantial losses if the market moves against your position. So always remember you're comfortable with the potential downsides before you start trading. Now that we've done a quick overview on the advantages and disadvantages of leverage ETFs, let's check out 3 of my favorite leverage ETFs and compare them to their actual stocks or ETFs and see how they line up. First up, I have NVDL pulled up right here on Robinhood, and let's see what Robinhood says NVDL is. NVDL provides us 2x leverage exposure, less fees and expenses to the daily price movement for shares of the NVIDIA Corporation stock. So let's go over to the NVIDIA options chain and see how much it would cost us to sell one put on NVIDIA. So I'm going to pull up NVIDIA, go sell put. So this is for the upcoming Friday. I'm going to go down, try to select a delta of about 20. So I think, yeah, this is delta 20 right here. And with a strike price of 103 times 100 shares would end up being 10,300. So to sell one put on NVIDIA a week out would cost us 10,300 in capital. Now let's go over to NVDL and see how much it would cost us to sell one put option on NVDL. Same expiration, about a week out and 20 delta. So let's see, come down right here. So if we do a strike price of 34, oh well, I have the call selected. So sell put, and a 34 strike price is about a 20 delta. So a 34 strike price means 34 times 100 shares would require $3,400 in capital. So if we sell one NVDL put with the same 20 delta, it would cost us $3,400 instead of the 10,300 with the actual NVIDIA stock, which allows somebody with a small account of less than 5K access to the movement of the NVIDIA stock with 1/3 of the capital invested. In fact, for all those that have an account of 10K, you can easily sell 3 NVDL puts instead of one put for the same capital. Next, let's look at our rate of return in each case, selling an NVIDIA put versus selling an NVDL put. So first, I have NVIDIA options chain pulled up right here on Robinhood. We have the same expiration of April 4th, going out a week, and we selected the 103 strike price earlier. So the 103 strike price provides us a premium of 0.95 or $95 for 100 shares. So let's do some math right here and see what return on investment we're gonna get with this selection. So 95 divided by 10,300, which is the actual cost or investment to sell one put option. So that's a return of 0.009 times 100 to get us a percentage. So that's about 0.92% or almost 1% weekly. Now you do it times 4, and that is a return of 3.68% per month, which is, not bad, pretty good actually. So let's do a comparison now with NVDL and see how much money or what's our return on capital doing the same thing on NVDL. So sell put, and we previously selected the 34 strike price, and the 34 strike price is giving us a premium of $71 a week out. So let's do the math again. So 71 divided by the 3400 is 0.02. That's almost 2%. So I'm just gonna do times 100 to convert this in percentage. So that's 208% per week times 4 weeks in a month, which is 8.35%. So, I mean, that is absolutely phenomenal. So as you can see, not only did we invest 1/3 of the capital with the NVDL put, but we also got a return of 8.65%, which is almost 2.2 times the return of the NVDA put. So the next ETF I want to talk about is TQQQ. TQQQ provides us 3x leverage exposure to the NASDAQ 100 or the QQQ index. Let's go over and pull up QQQ and see how much it would cost us to sell one put option with an approximate delta of 20, just like we did in the previous example. So since QQQ has daily options, I'm gonna go out to next Friday and let's look at a delta of about 20. Let's look at the 453. Yeah, this is almost a delta of 20. So right here, as you can see, with a strike price of 453, it would cost us 45,300 to sell one put on QQQ. So again, if you have a small account of 5 or 10K, it's pretty much impossible for you to come in and sell a put on QQQ. So let's go over to TQQQ and see how much it would cost us to sell one put on TQQQ. So same selection, sell put, going a week out and choosing a delta of 20 or close to 20 to keep our comparison similar. So this is a 53 strike price at 23 delta. This is a 52 strike price with a 19 delta. So we could go with this option right here. This is just fine. So a 52 strike price right here times 100 shares would cost us 5,200. So again, if you're somebody with a small account of $5,000 or $10,000, you can easily sell 1 or 2 put options on the TQQ. And again, it would give you access to the movement of the QQQ or the NASDAQ 100 index. Next, let's do some math and calculate a return of investment selling one put option on the TQQ versus selling one put option with the QQQ. So I have the TQQ option chain pulled up right here, and let's see, we selected the 52 strike price earlier. So the 52 strike price gives us a premium of $78. So 78 divided by our cost of 52 or $5,200 is the capital required to sell one put on the TQQ, and that gives us a return of almost 1% per week times it 4 weeks. So that's 6% return. Now let's go on the QQQ options chain and see how it's looking. Sell put, go to the same expiration date a week out and select the 453 strike price. I believe this one gives us a premium of 219 or $219 divided by the strike price of 453 or 45,300, which is how much it would cost us to sell one put on the QQQ. And this is 0.004 times 100 to get back in percentage. So 0.48% per week times 4 weeks. So it's about If I round it off to 2%, so it's about 2% compared to 6%, which is basically the 3x leverage return with the TQQ. So last but not least, I want to talk about my third selection right here, which is TSLL, and TSLL gives us 2x leverage to the Tesla stock. So with everything going on with Elon Musk and Tesla at the moment, I suggest taking extra precaution trading not only Tesla, but TSLL, as it is volatile at the moment. So now that that warning is out of the way, let's go over to the actual options chain and see how much money we can make selling Tesla and TSLL. So I have the options chain pulled up for Tesla right here. Sell put going out to April the 4th and trying to look for a delta of 16 or 15 to 20. This one's about a 16 delta. This will work for an example right here. So to sell one put on Tesla would require 23,500, which again, if you have a small account of 5,000 or 10,000, this is out of the question. So let's see how much premium, or actually let's see how our rate of return looks selling one put on Tesla. So this option right here, again, 16 delta gives us $3.05, or 305 divided by 23,500. And we have a return of about 1% times 4, so times 100. So right now, just selling one put on Tesla, you can make about 5% monthly. So again, it is extra volatile at the moment, so the premiums are looking great. And let's do a comparison with TSLL and see with the amplified 2x returns on TSLL, how much money we can make, or what's a return, what's our rate of return selling one put. So I'm going to do the same thing right here, try to come up with a delta or look for a delta of about 16 right here. And we're collecting $23. So let's do some math here. $23 divided by 8. So again, to sell one put of TSLL, it would only require 8 times 100, $800. So if you're somebody with a small account of 5,000, you could easily sell 5 puts. Or, if you're somebody with an account of $10,000, you can easily sell 10 puts on TSLL. Again, with a Tesla put, it would require 23,500, which is not possible for somebody with a small account. So going back to our rate of return here. If we divide 23 by $800, which would be the capital required to sell one put, that comes out to a return of almost 2%, or 2.8. So times 100, so 2.8% weekly times 4 weeks. So that's 11.5%. So again, with the 11.5%, that's almost 2x the return of selling one put with Tesla. So there you have it. If you are a small account options trader, you now have a way to trade 3 excellent leverage ETFs with capital of less than 5 or 10K. If you enjoyed this video, please give it a thumbs up, share it with your friends, and leave your comments below with any questions or thoughts. Thanks for watching. I'll see you in the next one.